We have just talked about cash and cash equivalent. Now let's look at account receivables. So what is account receivable? Account receivables are receivables resulting from the sale of goods or service on account. So there are two keywords here. The first keyword is it is resulting from the sale of goods or service. Or in other words, it is trade related. The other keyword is it is on account. Or in other words, it is credit sales. So it is not cash sales. And how do we value account receivable on the firm's balance sheet? So account receivables are valued on the balance sheet at its net realizable value. And what is net realizable value? Net realizable value is the amount the company expects to receive in cash at the time of collection. So this definition is very important. Net realizable value is different from the amount the company is entitled to receive. For example, if I run a bakery, I sell cupcake. So if I have sold 100 cupcakes at $5 each, $500, that is the amount I am entitled to receive. But what I may really end up receiving, it may be different from $500. A lot of the things may happen in the future, which may make the amount I really receive in the future smaller than $500. So, and the amount I expect to receive in cash at the time of collection, that is the net realizable value. It is not the $500, the amount I'm entitled to receive. And specifically, so what may affect how much cash a firm may really receive at the time of collection? So there are different conditions that may affect how much money the firm may really receive at the time of collection. The first is trade discount and cash discount. So those may affect how much money the firm really receives. What is trade discount? So for example, the listing price of an item is $10, but I'm selling it to you for $8. And this is called trade discount. I'm giving you $2 trade discount. And what is cash discount? Cash discount is also called sales discount. So an example is, so for example, when I sell you something, I'm telling you, hey, so I'm sending this to you on account, so you don't need to pay me now. You can pay me in the future, but the total amount you need to pay me within 30 days. So the total amount is due within 30 days. However, if you pay within 10 days, I will give you 2% discount. So this is called cash discount. It is a sales discount. If you pay earlier, so this discount is conditional. It is different from trade discount, which is unconditional. Sales discount or cash discount, it is conditional. It is conditional on how early you pay me. And this term is written as 2 out of 10, n out of 30. So n out of 30 represent you need to pay me the whole amount, no matter what, within 30 days. And 2 out of 10 means that if you pay me within 10 days, I can give you 2% discount. So let's do another example here. If the condition of my cash discount is the total amount, if it is due within 60 days, and if you pay within 20 days, I will give you 5% discount. Then how would you write it? Please take 1 minute, think about it, and you can pause your video for now. So for this condition, it is written as 5 out of 20 and n out of 60. The total amount is due within 60 days, no matter what. But if you pay within 20 days, I will give you 5% discount. So this is how we write this. So this are the first two conditions that may affect how much cash from really receive. And then there's some other conditions which may affect how much cash a firm eventually receive. What if customer return their goods in the future? So a lot of the goods can be returned into the, after the firm has sold it, it can be returned. So what if the customer return it, right? So that may also affect how much cash I really receive in the future. And what if customer do not pay? So if my customer have some financial issue and they were not able to pay, what if? So what if it may also affect how much money I really receive in the future? So those are some of the common situations that may affect how much money the firm really receive in the future. Or in other words, those are the common conditions that affect the net realizable value of a firm's account receivable.